Well, thanks to Laura, and thank you for the BVCA for facilitating and having us. So as Laura said, my name is Kier. I lead Aon's IP solutions business for the UK and Europe. And the discussion we want to have here today is how potentially different forms of financing can lessen some of the economic restraints that we have here today in the UK. And for context, and many in this room will know this well, but for context, many different studies put the UK funding gap at roughly £15 billion. That's a gap that is an annual gap. It's a gap that has grown since COVID, and it's a gap that is most keenly felt by some of our most promising IP-rich firms. So IP-rich firms can be companies in the deep tech sector, companies that have spun out of universities, or companies that have maybe filed a patent. There are 1,000 IP-rich scale-ups that haven't raised a single penny of equity capital. And those are the ones that are already successful independent of that equity capital, but there's an opportunity cost. There are 14,000 that haven't been able to raise equity capital and are still in that startup phase. And these are some of the most exciting companies for the economy. They're solving problems related to climate tech, environment, medical, but they're also significant economic contributors. IP-rich companies will generate growth, or they're more likely to lead to high growth companies 34% of the time. So they're an economic contributor. They're also an investment decision. So if you exit an IP-rich firm in later stage venture, that'll be at a 50% higher return than a non-IP-rich firm. At acquisition stage, so if you exit via acquisition, it's 150%. So it's both an economic problem, but also an investment opportunity. From an Aon perspective, you wouldn't necessarily think that we'd be participating in this conversation. It's a time that or it's an area that we've spent a lot of time recently with the Insights report due to be launched in November. We've been caucusing leaders from across the industry, whether that's in banking, in venture, in government, to understand what are the necessary solutions to specifically reduce that gap, and how potentially different forms of financing can play a role. We know there are improvements with the UK rejoining Horizon. We know that the Mansion House Compact will lead to something, but the response that we're getting from these leaders is that perhaps not soon enough. And so Aon, in the venture space, we have created a solution to enable IP-rich firms to raise non-dilutive capital using their IP. We do that by ensuring the value of IP and creating a new financial product. And through that structure, we've helped firms from the UK to the US raise north of $2.5 billion of capital in the last 3 years. So it's one of the fastest growing forms of alternative finance, which may have an impact on the UK funding gap, but enough from me, much more interested to hear from some of the leaders across the ecosystem. So I'll start with a leading question and then kind of ask you guys to introduce yourselves. So how tough is it right now in the UK, Amelia, for firms looking to raise capital, maybe at Series B, kind of deep tech type company?
Yeah, thanks, Will. Good morning, everyone. My name's Amelia Armour. I'm a partner at Amadeus Capital Partners. We're an early stage deep tech fund, but we have a number of companies that have grown to the Series B stage. And at the moment, it's been pretty tough. You know, in Europe, we've seen a peak of funding into VC-backed companies in Q1 22. Last year, there was 104 billion euros that went into European companies. This year, it's probably going to be about half that. There was 25 million in the first 2 quarters of the year. And so it has been difficult. There is less capital around. And so certainly our Series B companies have been taking measures to extend their runway, either that's through cutting costs or taking money from inside investors. But that has been frustrating because it's limiting their growth. And so finding other ways to support their financing, alongside the venture funding is really important. But at the moment, it's certainly pretty difficult.
Julian, you obviously sit in a slightly different chair, having been out there on yourself. What's the environment like from a business leader's perspective?
Well, I can say, as having been in the tech business all my life, so over 35 years of trying to get with this 15 billion funding gap to face. It's tough out there. But I mean, we're part of the ESG. There's a bit of ESG focus for what we do. We're an environmental polymers company. So I mean, there is enthusiastic. It's no difficulty getting through the doors and meeting people. But actually, sort of getting people to close because of the complexities of our sector, particularly, which is the plastics sector, environmental plastics. There's a lot of sort of misinformation out there. So it's very difficult to actually get it. And what we find is actually having the people who've got the knowledge in the industry, the finance industry particularly, outside the public sector, where you've got analysts who actually really understand the business and the requirements as to what drives it. We heard Oliver Dowd saying earlier he wants to fund businesses, but it's the how you actually do it and what the means are. So I've been working on the Aquapat project for over a decade now.
Karen, final thought from yourself?
Yeah, so I represent Founders Forum. We're a global community of entrepreneurs, and essentially we're also building the Virgin group of entrepreneurs, so building service-based businesses for entrepreneurs with disruptive business models. We're passionate about this space. If the UK is going to be a technology superpower, and I'm sure Oliver Dowd mentioned that this morning, we have to get into deep tech and we have to excel in that field, and it's one of the most exciting fields yet. Unfortunately, there is so much risk averseness to it because of this lack of knowledge. The reality is it's much, much longer runway. We held a dinner with some climate founders last week, and I asked them, when's your profitability return? And they sort of said 2035. There's very few people in venture that are interested in that runway right now, but we have to take the risks and we have to get into that. It's capital intensive from a staffing point of view, from a resources, from an infrastructure point of view. But this is the piece that we need to unlock for sure. And I think some of it is education, but some of it is that really longer term risk appetite, which the UK government also needs to help support with.
Can I add to that? Because the way I see the deep tech companies is a bit like the life sciences companies, is that they can go for quite a long time without any revenue. But the difference in the life sciences companies is they achieve these milestones, which are well understood by the investors, and so they continue to fund them. The problem I see with the deep tech companies is these milestones are not so well understood by investors. And so it's very difficult to get later stage capital to come in and take the risk appetite, which makes it much more challenging because they take longer to get to revenue. But the investors are looking for revenue at Series B, which they just don't have.
Yeah.
Caroline, maybe staying with you, your role, your community is global by nature. You also have kind of access to founders and leaders from startup all the way through to some of the most successful scale-ups. Maybe an international, but also kind of progression-based perspective on what it's like to raise capital and the alternative forms that some of your community consider.
Yeah, I think this, Amelia touched on it in the sense of still this sort of risk approach at the earlier stage, but it's really between the sort of Europe and US right now. We're seeing half the amount of investments in this year, both in terms of volume, but also the deal size. I think the founders across Europe are sort of a bit, but we're seeing, that's happening in the US as well. I think just the reality is that Europe is still very much focused on early stage funding. And what we have to do is unlock the larger investment funds to be able to get into the growth stage, because the US is still hammering us in that regard. There are some real green shoot opportunities. I mean, Sequoia and A16Z opening their offices in here and really starting to expand. They see the potential of Europe, and I do really think it's here. But it's for sure tough for the founders right now.
And are those structural issues, or are those cultural issues, or a mixture of everything?
I think it is still that appetite for risk. And perhaps that's inherent in the European founders' nature as well, where we're just slightly more not ambitious enough in the numbers and the potential of the future.
So Julie, maybe from an ambitious UK-based company's perspective, your journey over the last 10 years, you mentioned you've spent at Aquapac. How do you balance raising capital to solve the immediate need versus that longer-term horizon, and what are the right forms of capital to do that?
Okay, well, I mean that's the eternal question in the boardroom. Yeah, every time. So obviously, there's a great pressure when you have a technology, an emerging technology, to validate it through some very clearly understood way of validating, which is revenue streams. And so the pressure is when you're building a technology to try and find quick wins, minimum viable products type things to access markets, so that the capital markets can understand through a revenue stream, and you're validating the revenue stream. Whereas in actual fact, I mean, in some cases, I mean, in our particular case, we're developing a technology platform. I mean, just to say very, very quickly what it is, we've taken a sort of well-known polymer, which is polyvinyl alcohol. That's, it's highly functional. It's used in windscreens, but it's also water soluble. It's used in detergent pods. And we've actually created a thermally processable form to make sure that we can access mainstream applications like make paper functional with giving it barrier properties, and wet wipes and things that are dissolvable. So in order to do that, there's a very long validation chain. You've got to build infrastructure, otherwise they won't take you seriously. We're working with major brands, sort of looking at things like condiments, sachets, pet food, so industrial wet wipes. But to do that, they won't come through the door unless you've got infrastructure and you can show you're building the integrated supply chains that are required. Otherwise, you only look like part of the story. And the industry has not helped itself because there's a lot of technologies out there that claim headlines like seaweed. It's the latest, greatest thing. And all of them have got a role to play, but they're only part of the solution. There's limitations in the chemistry and the functionality. So I think that the journey, the real difficulty is we've done 14 separate fundraising rounds over a sort of 12-year period of various kinds in order to get to fund to the next value point, which was some sort of commercial opportunity or a joint development or whatever it was. But the journey is
running the business in between.
Running the business in between is very, very challenging for the management team because it's a big distraction. And we found ourselves actually last year we were looking for the next major stage, which is to push ourselves to the last 2 or 3 years into some major launches with some of these brands. And trying to go into the equity markets last year to do that was very, very difficult and challenging because of all the geopolitical side. So actually getting our partnership with Aon and a lender, we were one of the early adopters of the instrument that we were talking about, was actually a blessing because we finally got that expertise, somebody to look at a big team who looked at it and took the trouble to see through all the greenwashing issues that there are in plastics and misinformation about what's happening in our industry, to actually take a views to help us navigate our way through that.
Carolyn mentioned a little bit about risk appetite, I guess, on the founder side. On the investor side, though, Amadeus is one of the most well-known deep tech investors in the UK. A successful commercialization might happen after 10 years. Some fund life cycles don't last 10 years. How do you marry that? What are the challenges from your perspective with the deep tech portfolio that you have and their need for alternative financing despite some of those structural issues?
Yeah, that's right. We have to fund the companies so that they reach full value, because we don't want to sell them early as just tech assets. And at the moment, I see some of the companies being very creative in getting that funding. So, raising money for investing in manufacturing equipment in the UK is hard. So you see companies adopting different business models to help with that. So going down a licensing route so that they don't have to invest in the capex themselves. And then also taking different forms of investors. So going to people within the supply chain who understand the value of the technology and the product much more closely than a traditional VC will do, and then taking money from people within the supply chain. So it's being a lot more creative to get these companies funded. It's fine when you get to revenue. Other people will come in because they'll just be looking at the revenue metrics, but it's funding them through that sort of maybe 6-year period until you get to reasonable revenue that then you can look for other forms of funding. And I think once you've got equity funding, there are other things that you can bring in alongside, which are different sort of debt products which companies will look at. But it's balancing the cost of those and the flexibility of those and what the terms are versus taking your equity funding. So I think the IP product that you have is very interesting for these companies who have huge IP portfolios. And it's marrying, the cost of that versus taking equity, which is important.
So maybe continue on that theme. The cost of equity is dependent on the market and obviously the supply within that market. A recent Crunchbase article talked about directional consensus for the market rebound, which is the $1 million, $1 billion, $1 trillion question, I'm sure for all in this room. So I'd be keen to hear the different perspectives from each of you, but also in that intervening period until that market rebound occurs, how important are alternative forms versus after that rebound? How do you think about the mix of alternative forms?
Yeah, so I suppose in the last 18 months, 2 years, there's been this correction in how founders see the value of their business and how the market sees it, and those are now more closely aligned. So we've been through this period of maybe people taking down rounds, taking extensions of rounds, taking debt from their investors, and that has seen companies through. And I think we're now entering a bit of a crunch point that some of these companies are going to come to the end of that internal financing and hit the wall, which is not a bad thing. Now we'll be seeing these quality companies getting funding. And in terms of sort of a rebound, I'm starting to see more overseas investors interested in coming back into our companies, but they're looking for operational efficiency. They're not, they're making sure that companies aren't wasting capital. There's been a lot of headcount reduction in some companies, which has actually not affected the top line, which is good. And so driving these sort of better performance metrics is positive for the market as a whole. And I'm optimistic that sort of going into next year, when we start to hopefully see, some of this pension money coming online, that we'll be able to get these Series B and onwards companies funded with much more substantial amounts of money, so that they can go back to growth rather than just sort of treading water at the moment, which a lot of them are doing.
Julian, do you agree? Q2, Q3 next year, bit of a rebound?
Yeah, that feels about right. I think we're very much in the environmental ESG space, so there's a lot of enthusiasm, and because we're a manufacturer, there aren't many new raw materials coming through in our sector, so there's a lot of enthusiasm. So the macroeconomic sides feel less relevant for us, but what's more relevant is actually how the industry is the government's going to support, and how the regulatory environment will work, and then how all the capital, this expertise comes through into the markets to determine and separate out the wheat from the chaff, really.
Caroline, almost Q2, Q3 feels a little optimistic for the rebound. Is that what you're hearing from founders, or is there a concern it could lag longer?
I probably match Amelia's approach, which is it a downturn, or is it actually the right correction that needed to happen? And actually, a lot of our focus right now is really working with the founders who, frankly, have never had to sort of operate in crisis mode, into actually understanding how to manage their cash flows and building their teams. And it's just more of a realistic situation, unless you're a Gen AI company. And it's fascinating how many companies are now calling themselves AI companies, and then no problem, just ride on that wave, because the volume of cash going into that market now is incredible. But again, as soon as the big tech players wake up, then I think we'll see consolidation left, right, and centre in that space as well. So I do think it is still around. I think probably later stage of 24 at the moment, from what we're hearing, feels right. I think on the point of alternative sources, what we're also seeing across Europe is now we're really getting to a mature stage and they have a real passion about giving back into the technology space, so actually galvanizing more of an angel community to come in and actually give them both the operational expertise of how you scale those companies, having done it the first time round, as well as then injecting cash and capital is another sort of source that we're trying to support strongly.
Perfect.
Could I do a small request? Because I think what's a really good scheme that we've had in the UK is our EIS scheme for getting money into early stage companies. And what we're seeing, again, with these later stage companies is they hit the knowledge intensive sort of limit of taking their 20 million. And so, extending that limit so we could, again, sort of get more money from EIS sources into the later stage companies would be great.
Well, thank you all for the different views. We're coming to an end. I think the takeaway for me is that we're coming out the other side, whether it's a correction, a rebound, or a stabilization. At some point in 24, there will be an adjustment. And until then and after that, I think different forms of financing are going to be necessary alongside the leaders that exist within the VC community. So many thanks.